WorldCom scam was a massive accounting controversy that surfaced in the summer of 2002 at WorldCom, the United States' second largest long-distance telephone provider at the time. From 1999 to 2002, WorldCom top executives led by founder and CEO Bernard Evers organized a conspiracy to inflate earnings in order to keep WorldCom stocks price stable. In June 2002, the company's internal audit team, directed by the unit vice president Cynthia Qua, identified nearly $3.8 billion in false balance sheet entries. WorldCom was eventually forced to acknowledge that it had overstated its assets by more than $11 billion. It was the biggest accounting scam in American history at the time. The story of WorldCom 1983, when businessmen Murray Waldron and William Rector sketched out a plan to create a long-distance telephone service provider on a napkin in a coffee shop in Hattiesburg. Their new company, Long Distance Discount Service (LDDS), began to operating as a long-distance reseller in 1984. Early investors Bernard Evers was named CEO the following year. Through acquisitions and mergers, LDDS grew quickly over the next 15 years. The company changed its name to WorldCom, achieved a worldwide presence, acquiring telecommunications giant MCI. They eventually expanded beyond long-distance service to offer the whole range of communication service. During the period of internet boom, WorldCom stock rose to $60 a share, and Wall Street's investment banks and analysts and brokers began to mark WorldCom's value and made strong buy recommendation to investors. During the 1990s, WorldCom became the second largest long-distance phone company in the US, mainly due to the successful acquisition strategy.
Because of acquisitions, the market price of the share increases, and due to which the company gained greater financing from banks for further acquisitions. In the year 1998, WorldCom and MCI announced its merger, and this was one of the greatest mergers. After this merger, the company came to the second position after AT&T in the telecommunication market. But still, how they could have suddenly fallen, and what led to their demise? There were several factors that pushed WorldCom into a loss. The company pursued acquisitions aggressively, buying up rival companies in an attempt to gain market share. This, coupled with a major drop in revenue and rates, pushed the company further into the red zone. Executives needed a way to prove WorldCom was still financially viable to its board and shareholders. The gradual failure of WorldCom started by the disruption of acquisition cycle when they planned acquisition of Sprint Corporation in 1999 and 2000, and that did not work out because of pressures from the US Department of Justice and the European Union over concerns of it creating a monopoly. Because of this, WorldCom lost its main growth strategy and had to change to some other growth strategies. Either they had to mix all the previous acquisitions of the company into one entity or businesses, which they had failed to do, and this was the beginning of their downfall of WorldCom. So how the fraud happened? In 1999, revenue growth slowed and the stock price began falling. This was due to the expenses as a percent of revenue had increased due to slowed growth. To increase revenue, WorldCom reduced its money in reserves by $2.8 billion and moved that money into its revenue line in the financial statements. That, however, wasn't enough to boost the earnings that WorldCom need to meet expectation. In 2000, WorldCom began classifying operation expenses as long-term capital investments. Hiding these expenses in this way gave them another $3.85 billion. These newly classified assets were expenses that WorldCom paid to lease phone network lines from the other companies to access their networks. They also added a journal entry for $500 million in computer expenses, but supporting documents for the expenses were never found. These changes turned WorldCom's losses into profits to the tune of $1.38 billion in 2001. It also made WorldCom's assets appear more valuable. How was it discovered? The internal audit team had noticed accounting irregularities in MCI's books. The SEC requested that WorldCom provide more information. The SEC became suspicious once AT&T was losing money, but WorldCom on the other hand was making so much. The internal audit turned up the billions WorldCom had announced as capital expenditure, as well as $500 million in undocumented computer expenses. There was also another $2 billion in questionable entries. WorldCom's audit committee was asked for documents supporting capital expenditure, but it could not produce them. The controller admitted to the internal auditors that they weren't following accounting standards. WorldCom then admitted to inflating its profit by $3.8 billion over the previous 5 quarters. A little over a month after the internal audit began, WorldCom filed for bankruptcy.